Hello and a very warm welcome to this special show with Honorable Mehmet Simsek, who is Minister of Finance at Republic of Turkey. It's a pleasure having you, Minister, on our show here. First of all, there's so much happening in the global markets, and the markets are abuzz with the latest tennis deal that European Union has really stuck with Greece. What's your own opinion on that?
Well, Europe has been a big drag on Turkey's macroeconomic performance. So anything that would help Europe recover, anything that would help Europe pull out of, this almost state of permanent stagnation would help. Europe is our biggest trading partner. It accounts for over almost 45% of our exports, almost 60% of tourist arrivals, and about 75% of FDI inflows. So the health of European economy really matters to us. And of course, we would like a stable, prosperous neighborhood. So Greece is our neighbor, and anything that would help them overcome the recent difficulties would certainly be welcome.
Absolutely. There is this constant quantitative easing that has continued from European Union, and it would impact emerging economies and other developed markets as well. And the Indian ministers itself, whether it's Jayant Sinha or the RBI Governor Raghuram Rajan, have pointed out that a constant quantitative easing perhaps is not in the best of health for all of these economies.
Well, in the long run, certainly there are concerns, but in the short term, it did help the United States. Quantitative easing, at least in the short run, may help in the sense that we don't have, unlike in 1990s, a synchronized global monetary tightening. So while the US Fed is on the eve of some sort of tightening, or at least that's what's expected by the markets, same with the UK. So if you get quantitative easing in Japan and by ECB, at least you don't get the synchronized global monetary tightening. So that may help mitigate the fallout from tightening in the US. That's for emerging markets like Turkey and India, etc.
For the longest time, it has been said by a lot of European Union ministers that the Euro marriage is forever. Divorce as a word doesn't work there. But we have this new coined word called GREXIT. Do you see that happening, and what would be that impact on the emerging economies then?
Well, Europe is not just a free trade area. It's not just an economic union. It has an ambition to achieve a political union. And that's what I think makes it complicated to have one of its members exit in one of the structures. It wouldn't be appropriate for me really to make any predictions. But we can see the difficulties with Euro. You still have nation states, some degree of convergence in policies, but not necessarily as a one nation state. So that's where the difficulties are, because you have different parts of Europe at different degree, with different degrees of competitiveness, with different degrees of labor market flexibility. So you can understand the challenges there. But as I said, we are an EU accession candidate. We've been negotiating a full membership. The process is still ongoing, even though it's been slow. And we would like Europe to succeed. And therefore, it's in our best interest.
So just taking on your previous point, when you said that quantitative easing has been good, a lot of economies, including ours and yours, have been making, have been able to make a benefit of that. So, but Turkey also ended up borrowing quite heavily during the times of easy monetary policy. Would you call Turkey economy at this point in time a very, very highly leveraged economy?
I wouldn't actually. Recently, McKinsey put out a report on leveraging and deleveraging. And Turkey has one of the relatively low leverage ratios. Overall, public, private, entire debt, excluding financial institutions, is 104% of GDP, 104. If you look at government alone, our gross debt to GDP ratio is down to 33% last year. Now, keep in mind that OECD average is over 112%. EU average is 96%. So Turkey is relatively less leveraged. If you look at Turkish households, the leverage ratio, household debt to GDP is about 22%. That compares favorably with 64% for European Union. Usually we use Europe as a reference for us but the point I'm making is Actually, private sector did, borrow in the last decade, but from a very low level of leverage. So yes, there has been a strong momentum, but in terms of level of leverage, still Turkey is quite modest.
Okay, we'll take your word for that. You pointed out on the McKinsey report. I would also want to bring your attention to the Morgan Stanley report, where they have come out with fragile fives, where India and, of course, Turkey, Indonesia, South Africa, Brazil, all are a part of it. These are perhaps the economies which would be most impacted when we see the withdrawal of quantitative easing coming in. What's your sense on how Turkey and India stand together in that, and how would you as an economy look at it?
In the long run, as I said, growth is key. And I think that's where we should look at the countries you mentioned. So these countries may have short-term difficulties on the back of, what has happened over the last decade. I mean, we've had quite a bit of tailwind for emerging markets coming from relatively easy monetary policies. Going forward, that's not going to be the case. So we understand that. So we need to adjust to some sort of new normal, maybe a more modest growth rates. But I think some countries that reform, like India, which has done an impressive job. I think Turkey is also following same track. Okay. Will succeed.
But mentioned about quantitative easing, while we did overcome how the Fed tapering happened in 2014 and ended in 2014, started in 2013 and ended in 2014, when that actually starts coming in from the European Union, China has been a part of it, Japan has led to a lot of easy stimulus. How would you see a reaction then coming in for these economies? And of course, add to that the Fed interest rate hike that the markets are right now speculating with.
I think some sort of global monetary normalization, that follows tapering or, an expansionary era. Initially, it does cause some disruption in financial markets. So volatility is understandable.
But would you just call it ripples, or do you see an overlasting impression?
No, I don't think. Well, let's put it this way. We have more headwinds for emerging markets simply because Western consumer is not going to be as strong as it has been in the past if we get some sort of monetary policy normalization. That's true. Now, global commodity prices matter for most emerging markets. Now, keep in mind, India and Turkey benefits significantly from lower oil prices.
Absolutely.
So, in fact, we could decouple in a way. China also benefits from lower oil prices. Turkey was hammered by rising commodity prices. But now we might get a bit of a sort of a break. So it depends which country you're talking about. So those that reform and those that obviously had faced significant sort of tailwinds while commodity prices were rising probably will do better. And I think India, Turkey are part of those, a part of group that will probably do fairly, or much better. Quantitative easing, as I said, may help and has been helpful in the United States in the short run. But in the long run, there is no substitute to structural reforms. A lot of emerging markets, but also developed countries, have significant structural issues. Maybe different issues, but very significant issues. Europe clearly needs to reform. So that's really where I'm coming from.
Sure. You mentioned about the crude oil prices, and yes, we've seen the prices come down by more than 50%. It does help India with the current account deficit, as the numbers clearly show. How bigger boon has that been for Turkey in sense of numbers?
It hasn't really yet been reflected in numbers, but we will see that starting first quarter of 2015, this year. Mm-hmm. Why? Because usually you have contracts and it only kicks in with a bit of a time lag. But just to give you some color, a $10 decline in oil prices improves Turkey's current account balance by 0.5% of GDP. Okay. Very dramatic. It improves inflation, meaning reduces inflation by 40 basis points, 0.4%. It also helps boost growth by anywhere from 0.1 to 0.4%, depending on other circumstances. So clearly, it's good news for current account balance, it's good news for inflation, but it's also good news for growth. So Turkey has this tailwind right now.
It's been quite a bit of a currency weakness, with the Turkish lira hitting record lows, and the last 1 year hasn't been so good.
it hasn't been unique to Turkey, by the way. I mean, if you look at year to date, I mean, there are all sorts of typical emerging markets out there. But understandably, lira also has been under pressure because countries that were crowded trade in the run-up to tapering decision, understandably saw more volatility and more weakness. So clearly that's the case. Now, looking ahead, I think the decline in oil prices will help disinflation. It looks like, looking at the rainfall, the weather conditions so far, it looks like there's now going to be a repeat of a drought. Currency is the wild card out there, but looking at the bigger picture, there is already a significant decline in inflation. The downtrend is likely to continue. Now, on the back of that, but of course taking into account all global backdrop as well, central bank probably has room to respond, but that's for them to decide. Even though there's been a big debate on central bank policy stance in Turkey, we've been of the view that central bank should act rationally, and they should take into account as their primary target the price stability, their inflation target. So that's really should be their core focus, and that has been the case.
Turkey's growth chart has been phenomenal, very encouraging. We've seen a lot of money flow come in as well. It has a third position number when it comes to the EU countries. Even in the OECD countries, it has been one of those strong performers there. 2014, what would you say went wrong, and how would you look at this new 2015 now?
Well, we had three major shocks. First of all, the disruption, the geopolitical tensions in the north, Russia, Ukraine, Middle East, Syria, Iraq, Libya. So we haven't had a good time. I mean, we live in a tough neighborhood, but it's been very tough. So that's first. That has been a big drag on Turkish growth. Secondly, keep in mind that Europe also did quite significantly less, I mean, in terms of performance-wise. European performance was much weaker than what was anticipated, what was penciled in by IMF, World Bank. Thirdly, we had two elections, quite a bit of political noise. We haven't been in good headlines, but fundamentals haven't changed. So I think what has happened in 2014 was a temporary sort of situation. It's quite likely that Turkey will begin to recover, move back to what we consider to be trend growth in the medium term, which is about 5% for Turkey. I think it's achievable, but we're not an island. A lot of things are happening in our neighborhood, and we get affected. I'm sure other countries get affected, but in a limited way, because what is happening is right around, right over our borders. So clearly that has had a significant impact.
But there have been some positive statements as well. Russia announced that they would continue with the shift of flow of natural gas would go on through Turkey. So there are some positives in the sense of infrastructure and economy and business happening as well. Would you then say that 2015 has started positive? Do you see more growth coming in for this year, next year?
Well, I'm optimistic in the sense that ECB has launched this quantitative easing, so it should help Europe pull out of, as I said, this stagnation. So that would help. Secondly, it would really help if the situation in Russia, Ukraine stabilizes, which there seems to be some progress. Thirdly, I mean, last year was quite, in terms of, again, geopolitics, in terms of Middle East, we had quite a bit of disruption. So hopefully that won't repeat. So yes, in that sense, it started off much better. So that's first. Secondly, the decline in oil prices is clearly helpful, but we can't rely on what's happened outside of Turkey because some of those developments we don't have control over. So here's what we've done. We have a new prime minister. He brings in a lot of experience, but also intellectual capital to the table. And he began his new term with a very comprehensive structural reform program. We're actually very excited. Like, Make in India initiative. We're very excited to help push a very comprehensive reform program, put Turkey back on a higher growth trajectory for the next decade or so.
fair point. You know, one thing that India needs to learn from Turkey really is about the gold monetization. We haven't been able to crack that code yet, but you clearly have done that in the last couple of years. Both these countries are known as hoarders. We keep gold under the pillow, under the ground and all of that. How have you done that? And knowing that we also have gold inclined into us culturally, what would you want to tell Indians on that?
You know, you mentioned some reports on Fragile 5. Those numbers don't take into account, you know, all that wealth under mattresses. So that's why a lot of time those type of predictions, those type of, you know, reports, they don't really hold. And you have a very good point. Turks also sit on massive gold reserves, which are not part of the system, financial system. Here is what we're doing. We are encouraging them to bring in the gold, you know, hand it over to a bank or an exchange, whatever, and then in return have a gold deposit account, which seems to be working to some extent, but we need to do more. Clearly, like you know, our Indian friends, Turks also love to hold, you know, some of their wealth very close to them and not in the system. And, you know, we are.
Is it a good idea?
No, it's certainly not. I mean, you know, to create wealth, we need to channel more savings, more resources into financial system, and financial system hopefully will channel that to investments, about productive investments, you know, infrastructure, investments that would help improve productive capacity. And I think that's really key. So anything that would help in India or Turkey to, you know, make individuals feel comfortable about, still they can hold gold, but in a more monetized fashion, that would certainly help. And we're working on that.
Just one more buzzword, and that really has been ISIS. That is something that really has been bothering a lot of markets, countries, economies. What's your own sense, your own opinion on that, or where we're headed with that?
Well, Turkey is one of the, I think, the first 3 countries in the world to designate ISIS as a terrorist organization back when people weren't aware of the existing of such a terrorist. It's a barbaric terrorist organization. We have to make a common stand. We have to make a very strong stand. We have no choice. And ISIS is a bigger threat to Turkey than to any other country. So we cannot, despite some misinformation, despite some, you know, stories, Turkey has had a very strong stance on that. Unfortunately, we have a human tragedy going on in Syria. We have almost 900 kilometers of borderline. If we close our border to Syrian refugees, you know, running for their lives, it clearly would be unacceptable. And that's why we're hosting 2 million Syrian and Iraqi refugees. Now, that's a human thing. We need to do that. But when you keep your borders open, it's much bigger challenge to contain the rest of ugly stuff. But we are working with our Western friends and the rest of the world. We now have a much more effective system to prevent foreign fighters, etc. So ISIS is a big threat. But you also need to look at the root cause. I think desperation, you know, in Syria, daily, you know, destruction. I mean, you know that 7-8 million people have been displaced. About, I think, by some accounts, 300,000 people dead. You know, hundreds of thousands more injured. And we have, as I said, 2 million Syrian refugees. So clearly, the rest of the world cannot sit on the fence. We need to do something about this. But sadly, all sorts of differences of position, I mean, opinions, prevents from having a united stance. But when it comes to terrorism, international terrorism, we suffered a lot in the past. And we understand, and I think there is no good terrorist. There is no this terrorist. Terror is terror, and it needs to be eliminated. It needs to be, you know, clearly we need to work together.
So, you know, before we end this conversation, you are in India here. How do you look at India prospects under the Modi government? Because this whole Make in India thing, as you yourself pointed a couple of times, how big do you see that? How do you see Turkey getting itself involved into this?
Unfortunately, Turkey has had very strong focus on its immediate neighborhood, like Middle East and Europe, and so far has, and that's wrongfully ignored the rest of the world. Now we are about to change. We need to change that. India has amazing prospects, really. We believe in Indian story. I mean, you've done a great job, but I think what lies ahead is much more, amazing. So I've looked at, Make in India sort of initiative, and it sounds very exciting, and we want to be part of it. And I'm sure we will be, because we just need to have more policy level, political level interaction. The last Indian Prime Minister to visit Turkey was back in 2003. So I think it's time for Prime Minister. Yes, it's time for Prime Minister to. I mean, I know for G20, there will be a visit, but we want a bilateral visit. So that's first, because Turkish Prime Minister, Turkish President have paid visits in the past few years. So clearly, we need to have more dialogue. But of course, we can only pave the way for real actors, business people, to do deals, to work together, to invest, to do the trade. And I think that's key. And I understand that India is negotiating some sort of a free trade agreement with the European Union. And by the way, Turkey is a full member of Customs Union with Europe. So clearly, we would like to have a free trade agreement with India to actually prepare the ground for takeoff in India, Turkey investments and trade.
Are there any specific sectors that you are looking into India that do excite you?
Well, India and Turkey are very diversified economies. So unlike our neighborhood, we don't rely on hydrocarbons. In fact, we have none. We don't have much natural resources. Our only natural resource is our human capital, and we're trying to enhance the quality of human capital stock. But putting that aside, clearly there is huge upside in terms of linkages. I think in terms of infrastructure, in terms of automotive, in terms of food processing, in terms of energy, technology, IT. There's a lot we can learn from India. Indian companies could use Turkey as a base for the rest of the region, because Turkey has strong historic, sometimes linguistic, sometimes cultural linkages with, Balkans, with Middle East and Africa, with Central Asia. And India, I know, is looking at sort of broadening its markets. So clearly Turkey could help. There is so much we can do together. I mean, $7.5 billion of trade volume, it's almost nothing compared to what we could do. I mean, Turkey alone has $400 billion of trade volume. India has over $800 billion of trade volume. So clearly, where we are is it's low level, but it also suggests that there's huge upside. And similarly with FDI inflows, it's almost non-existent. But that's why we're here. We need to change that.
Well, on that positive note, thank you so much for talking to us, Mr. Minister. It has been a great pleasure having you on the show.
Thank you.
Thank you.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.